Choosing the right venture capital partner can be the defining moment for your business. But the wrong choice? It could steer you off course or leave your startup trapped in stagnation. The world of venture capital isn't a one-size-fits-all solution. There are three major types of venture capital firms. Those are corporate venture capital, micro venture capital, and traditional venture capital firms, and each offers a unique approach to funding. They also have significantly different criteria and funding capabilities. Today, we're diving into what sets them apart, what they bring to the table, and why your decision to partner with one over another might matter more than you think. To set the stage, let's clarify what venture capital is. Venture capital is private funding provided to startups and early-stage companies with significant growth potential. In return for their investment, VCs receive equity, a stake in the company. It's a high-risk, high-reward game, with the goal of identifying startups that could generate massive returns. The Holy Grail is a company that can grow to $1 billion in revenues in 5 to 10 years. Globally, the venture capital industry has grown exponentially. In 2023, VC investments totaled around $400 billion in the US, all of it in search for the next Tesla or Shopify. But not all VC firms operate the same way, and understanding the nuances is crucial to making informed decisions. Corporate venture capital firms represent the investment arms of large corporations. These firms, like Google Ventures or Intel Capital, don't just provide funding, they invest strategically to align with their parent company's long-term goals. The primary objective isn't solely financial returns, but also gaining insights into emerging technologies and markets. Let's take a look at the key characteristics of CVCs. Unlike traditional VCs, CVCs invest to advance their corporation's strategic interests. CVCs have financial and strategic goals that founders need to consider carefully. For instance, when Samsung Ventures invests in startups focused on semiconductors, it's not just about potential profits, it's about staying ahead in their core industry. Partnering with a CVC often grants startups access to the parent company's infrastructure, expertise, and customer base. For example, Intel Capital, one of the largest CVCs, offers startups mentorship from Intel's engineers and integration opportunities with its technology. CVCs typically invest in larger rounds, with check sizes averaging $1 to $10 million, depending on the stage of the startup. Aligning with a corporate entity can sometimes limit a startup's flexibility. For example, a partnership with one tech giant might deter competitors from working with you, narrowing your market opportunities. There are countless examples of success. CVCs have backed some of the most well-known startups. Google Ventures invested in companies like Uber, Nest, and Slack, while Salesforce Ventures has supported over 400 startups in the cloud computing space. According to CB Insights, CVC investments account for about 25% of all global venture capital deals in 2023. Companies with CVC backing are 70% more likely to receive follow-on funding compared to startups funded by traditional VCs. If your startup can offer a CVC a strategic advantage in addition to attractive returns, then go for it. Then there is micro venture capital firms, the underdog's ally. Micro venture capital firms focus on smaller, earlier stage investments, typically in the range of $100,000 to $500,000. They are more likely to be interested in a company that doesn't scale up to $1 billion a year in revenues. They may be satisfied with $100 or $200 million in revenues annually. They're nimble, focused, and often the first check a founder receives when building a startup. One characteristic of micro VCs is that they are founder-focused. Micro VCs often pride themselves on close relationships with founders, often spending time at the corporate office or manufacturing facility. Their smaller portfolios allow them to offer more personalized mentorship and guidance. Then there is specialization. Many micro VCs focus on niche industries. For example, Uncork Capital specializes in SaaS and marketplaces, while Version 1 Ventures focuses on blockchain and climate tech. Micro VCs operate at the riskiest stages of a company's lifecycle, often during the pre-seed or seed rounds. While many startups fail at these stages, the ones that succeed often deliver exponential returns. Higher risk means high reward. In fact, according to AngelList, seed stage investments have an average IRR of 21.3%, far outpacing later stage investments. Micro VCs have been instrumental in launching iconic startups. First Round Capital, a prominent micro VC, invested in companies like Uber, Notion, and Roblox when they were in their infancy. There are challenges. While micro VCs provide invaluable early stage support, their smaller funds mean they may lack the capacity to follow through in later funding rounds. This can leave startups reliant on securing additional investors. Micro VCs have grown significantly, with about 600 active firms in the US at the end of 2023, compared to just 200 or 300 a decade ago. Seed stage funding rounds typically range from $500,000 to $2 million, with micro VCs often contributing the bulk of the capital. Traditional venture capital firms are the industry titans. Traditional venture capital firms are what most people think of when they hear VC. These are the big players, managing billions in assets, constantly raising new funds and backing some of the world's most successful companies. Key characteristics of traditional venture capital firms is the large check sizes. These firms typically invest between $1 million and $100 million, making them the go-to choice for startups in later funding rounds or those with proven traction. Traditional VCs bring decades of experience to the table. The most experienced and savvy investors will be found here. Firms like Sequoia Capital, Andreessen Horowitz and Kleiner Perkins have been instrumental in scaling companies like Apple, Airbnb and Stripe. Traditional VCs often invest across multiple sectors and stages, creating a balanced portfolio where a few massive wins offset potential losses. With large amounts of capital to deploy, they diversify carefully and smooth out returns. In addition to funding, these firms offer unparalleled access to networks, partnerships, and top-tier talent. The impact of traditional VCs on global business is hard to overstate. Success stories are numerous, and the returns on those successes are among the highest returns achieved in the financial industry. For example, Sequoia Capital invested in Apple in 1978, helping the company go from a garage startup to a global tech powerhouse. Andreessen Horowitz backed Instagram when it was just an idea, leading to its acquisition by Facebook for $1 billion. Despite their resources, there are challenges for founders. Traditional VCs often have larger portfolios, meaning startups might not receive as much hands-on guidance. Founders can also feel pressure to scale quickly to meet growth targets, potentially sacrificing long-term sustainability. In 2023, traditional VCs accounted for 60% of all global VC funding, with over $250 billion deployed across various industries. The average VC-backed company takes 8 to 10 years to reach an IPO, highlighting the long-term commitment of these partnerships. So, how do you choose the right partner from these three types of VCs? Here are some critical factors to consider: stage of your startup, pre-seed/seed. Micro VCs excel here, offering the hands-on support needed to refine your business model. Growth stage. Traditional VCs or CVCs can provide the resources to scale rapidly. Strategic fit. If your product aligns with a specific industry, partnering with a CVC might offer strategic advantages. Check size. Smaller needs. Micro VCs are your best bet. Larger funding rounds. Traditional corporate VCs are more appropriate. Mentorship and resources. Micro VCs are often more hands-on, while traditional and CVCs provide broader systemic support. Ensure your investors align with your company's mission, values, and most important, long-term vision. A mismatch can lead to friction and missed opportunities. The power of the right partner is critical. Venture capital is more than just funding. It's a partnership that can shape your startup's future. Each type of VC brings distinct advantages and challenges. Corporate VCs offer strategic alignment and resources. Micro VCs bring agility and mentorship. And traditional VCs provide experience and deep pockets. In 2023 alone, over 10,000 startups worldwide secured venture funding, with the potential to redefine industries and create and serve new markets. The question is, will your startup be one of them? The right partner could be the key to turning your vision into reality. Choose wisely.